By the way, David, I am not suggesting that anybody have 100% of their net worth in gold or SpaceX or
Hmm.
anything else. The future is a set of probabilities. There's no certainty whatsoever. But I would suggest that for the American investing public, at least, I can't comment on the Canadians, uh, that gold, the market share of gold and gold related securities relative to other savings and investment asset classes is 0.5%, down from a 4 decade mean of 2%. I believe that we will, over the next 10 years, experience at least a reversion to mean, unless we have another 2008 style psychotic break in the market. I imagine personally, David, that the sell decision with regards to my bullion will be made by my estate, not by me.
Rick Rule, a longtime resource investor and founder of Rule Investment Media, has consistently argued that the real issue is not short-term price movements, but the deeper question of how people protect purchasing power across full economic cycles. Rule separates investing from saving in a very clear way. In his view, productive businesses and resource projects are meant to compound wealth over time, while gold and other precious metals function more like financial insurance against monetary instability and policy error. He does not promote gold as a tool for fast speculation or concentrated risk-taking, but rather as a stabilizing element in a broader portfolio designed to survive uncertainty. Rule's broader concern is that markets often focus too much on short-term signals while underestimating long-term monetary pressures that build slowly over time. He believes that this gap between perception and reality is where major investment opportunities and risks tend to emerge. Please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this.
My own life is driven fundamentally as opposed to technically.
Hmm.
I would suggest that the recent softness in the gold price has to do with three factors. The most important of which is higher U.S. nominal interest rates. Higher interest rates increase the attractiveness of the U.S. dollar and are tough on the prices of U.S. dollar denominated assets, with the possible exception temporarily, of course, of SpaceX.
Yes.
They also, I would suggest, correlate reasonably well with fears of a recessionary or a deflationary recession. And I think that people are concerned about the possibility of a credit collapse and a recessionary circumstance derailing inflation. I think that most of those fears are misguided. I can't tell you where the gold price will go in the near term. Nobody can, although many
Hmm.
people will try.
Hmm.
But I can tell you that the period that we are going through currently reminds me personally of no circumstance as much as 1975. And let me take some of your younger listeners through that period. The period 1970 to 1975 was characterized by an increasing fear of inflation in the population and an increase in the gold price from an admittedly price controlled $35 an ounce to a high, if my memory serves me well, of about $200 an ounce. The political fears around inflation caused the U.S. Congress to do something fairly unusual. They decided to do something about it, and they allowed interest rates to rise. And that increase in interest rates cratered the price of gold from about 200 to about 100. It cratered some other things too. The U.S. bond market, the U.S. equities market, durable goods sales, new home construction.
Yes.
Uh, and after a fairly brief period of time, Congress and the American political class, in fact, the voting class lost its nerve and abandoned any pretense in defending the sanctity of the U.S. dollar. When interest rates were forced down, it became clear to savers and investors around the world, not just in the United States, that political expediency was more important than the sanctity of the dollar. And after that happened, after the interest rates were engineered down, the gold price exploded from a low of about $100 an ounce to a high of about $850 an ounce. It took two things: very high real gold prices, and then a tripling of the U.S. interest rate under Volcker to finally break the price of gold in 1981. Gold then had to compete with a U.S. Treasury selling at 15. We're a long, long, long way from there. By the way, David, I am not suggesting that anybody have 100% of their net worth in gold or SpaceX or anything else. The future is a set of probabilities. There's no certainty whatsoever. But I would suggest that for the American investing public, at least, I can't comment on the Canadians, that gold, the market share of gold and gold-related securities relative to other savings and investment asset classes is 0.5%, down from a 4-decade mean of 2%. I believe that we will, over the next 10 years, experience at least a reversion to mean. There was a euro market in the time, a European market in gold, that had gold changing hands at 42 or 43 US dollars per ounce.
Yeah.
So the French called the US dollar's status as the world's reserve currency, or de Gaulle, pardon me, the exorbitant privilege. It allowed the United States to export its inflation. It allowed us to live beyond our means. And when gold was trading freely in the market at $42, and countries could exchange their claims, which is to say their overseas holdings of US dollars, for gold at 35 and sell it for 42 overnight, riskless, the temptation to do that was too high. President Nixon, remember, he had a war to fight. Well, two wars, actually. The war on poverty, which we lost, and the war in Vietnam, which we lost. He had two wars going on simultaneously, plus a third war, re-election, to consider. And the idea that he should end the exorbitant privilege that we enjoyed by printing away the difference between what we consumed and what we produced was too great a cost to him politically to bear. It was a cynical and temporarily successful move.
Rick Rule believes the current environment may be following a similar pattern. Policymakers today are again caught between two difficult goals: bringing inflation under control, while also trying to avoid slowing the economy too much. This kind of tension, in his view, often leads to shifting policies that can create long and unpredictable cycles in markets like gold. He also points to a bigger, structural issue in the global financial system. The United States has benefited for decades from having the world's main reserve currency. This has made it easier to run large deficits and sustain high levels of debt because global demand for dollars remains strong. According to Rule, this system can slowly reduce financial discipline over time since spending pressures are less constrained than they would be in a system with tighter limits. In this context, he sees gold as an important balance against ongoing monetary expansion. Unlike currency, gold cannot be created through government policy or central bank decisions, which is why he views it as a long-term store of value rather than a short-term trade. Now we present the clips from the interview.
The last time I sold gold was in 2009. And I didn't sell gold in 2009 as a consequence of the fact that I thought the price was going down. I bought it because I owned it as liquidity, and there were other asset classes that were cheaper. Occasionally, seldom, hopefully, one dips into one's savings to acquire assets that will increase their material standard of living. After the equities market collapse of 2008 and the credit market collapse of 2008, in 2009, there were a variety of financial assets that were on sale at such ridiculously cheap prices that they caused me to liquidate a bunch of my gold to buy, albeit temporarily, asset classes that were cheaper. For me, savings are just exactly that. I'm not trying to make money on my savings. I'm trying to maintain the purchasing power of my savings. I make money investing, which is differently than saving. I make money investing in high quality businesses or speculating in businesses that I believe might become high quality business, or investing in private businesses like Rural Media, the Rural Classroom, Sprott in the old days. But I save. I maintain my purchasing power in gold, unless we have another 2008 style psychotic break in the market. I imagine personally, David, that the sell decision with regards to my bullion will be made by my estate, not by me. There's no other reason why they would subject their family and themselves to what they have to go through. Their currency is power. Gold reduces that power. The power to allocate to your friends, the power to spend, the power to mandate circumstances that the economy wouldn't otherwise allow is what politicians live for. The discipline that would be imposed on politicians by the gold standard makes it completely implausible that they would embrace it. In non-financial terms, why would anybody choose to become a eunuch? To the extent that politicians imposed a gold standard on themselves, they would become financial eunuchs.
Rick Rule explains that the US dollar became the world's reserve currency after World War II, a position he calls an exorbitant privilege. This system gave the United States a major advantage. It could essentially create money and export inflation to the rest of the world, allowing it to consume more than it produced for many years. In simple terms, the world's demand for dollars allowed the US to live beyond its real economic means without immediate consequences. Rule then points back to the collapse of the Bretton Woods system in the early 70s, when gold was still partially tied to the dollar. At that time, foreign governments could exchange dollars for gold at a fixed price, but the market price of gold was higher. This created a situation where redeeming dollars for gold and selling it on the open market became highly attractive. According to Rule, this kind of pressure helped push the U.S. government to end the system under President Nixon. He argues that political pressure played a major role in that decision. The U.S. government at the time was dealing with major challenges, including economic stress, inflation, the Vietnam War, and domestic political pressure. Rule suggests that leaders chose flexibility over discipline, even though it meant weakening the link between money and real assets like gold. Thank you for watching, and see you in the next video.